All right, let's get ready to unlock some serious investment wisdom today. We're diving deep into the mind of Warren Buffett, the guy who turned investing into an art form.
He's not just an artist, he's practically a legend. And what's amazing is that his strategy isn't some top secret formula. It's actually built on principles anyone can grasp.
That's what makes this deep dive so exciting. We're using the Warren Buffett way as our guide, and I have to say, it breaks down his methods in a surprisingly clear way.
It's like having a backstage pass to the world of one of the most successful investors ever.
Exactly. So first things first, Buffett's a big believer in this thing called value investing. What's the deal with that? It sounds pretty basic, but I bet there's more to it than meets the eye.
Oh, there definitely is. Think of it like this. You're at a flea market and you spot a vintage record player that looks a little rough around the edges. Most people would walk right past it, but you see potential.
Okay, I'm intrigued.
That's what Buffett does with companies. Value investing is about finding those diamonds in the rough. Companies that the market is undervaluing, they might have hit a temporary snag, but their core is strong.
So it's like seeing the potential for that record player to be restored to its former glory.
Precisely. And just like with that record player, you wouldn't pay top dollar for it in its current state, right? You'd want a bargain.
Makes sense.
Yeah.
So how does he find these bargain companies? Does he have a sixth sense or something?
Well, let's just say he's incredibly sharp at spotting potential. Take Geico, for example. Back in the 70s, they were having some trouble, and a lot of investors were shying away. But Buffett, he saw right through those temporary issues. He saw the company's efficient model and believed in their long-term growth potential.
And that investment paid off big time, right?
Yeah.
Talk about a comeback story.
It was a classic Buffett move. He wasn't afraid to go against the grain. And his patience paid off. He's not about quick wins. He's in it for the long haul. Speaking of, remember how he bought a ton of Coca-Cola shares back in the 80s? Held onto them for decades and...
Yeah. You can imagine how that turned out.
Yeah. That's the kind of long-term vision I need to work on. But okay, let's say we found a potentially undervalued company. How do we know if it's a good investment? Does Buffett have a checklist or something?
He actually does. First up, strong and consistent earnings. It's like looking for a friend who's always reliable, always there for you. If a company consistently makes a profit, it's a sign of stability and strength.
So, like a friend you can always count on.
Exactly. Next on the checklist, the economic moat. It's basically a company's defense system, its competitive edge. Think of it like a castle with thick walls and a wide moat to keep out invaders.
Okay, that's a vivid image. Give me an example of a real-life company with a strong moat. Well, look at Gillette. They've been dominating the razor market for ages. Brand recognition, customer loyalty, a robust distribution network. These are all part of their moat. It makes it incredibly hard for competitors to make a dent.
So it's like they've built a fortress around their business.
Exactly. And last, but certainly not least, Buffett looks for honest and capable management. Think about it. Would you trust a captain who doesn't know how to steer a ship?
That's a disaster waiting to happen.
Right. Buffett wants to see leaders who are ethical, competent, and make smart decisions. He wants someone who can navigate those choppy waters. He always talks about how much he admired the management team at American Express, even when they were going through a tough time with that scare.
So he saw their integrity and believed in their ability to steer the ship back on course.
He absolutely did. And guess what? His faith paid off. American Express bounced back stronger than ever. It just goes to show strong leadership can make all the difference.
Okay, so strong earnings, a solid moat, and a trustworthy captain at the helm. Sounds like a pretty good recipe for a successful company.
It is. And remember, Buffett's not looking for quick flips. He's playing the long game. This isn't about chasing trends or getting caught up in the daily market frenzy. He's looking for companies that will stand the test of time.
That's where his famous patience comes into play, right? Mm-hmm. He's not exactly known for being impulsive.
Not at all. He's the ultimate buy and hold investor. He doesn't panic and sell when the market dips. He sees those dips as opportunities. Take a look at how he handled Apple. He didn't jump on board right away. He watched, he waited, he studied the company for years before investing.
I guess that's why they call him the Oracle of Omaha. He really does seem to have this incredible foresight.
He definitely has a knack for it. And his patience ties into another key concept, intrinsic value. Now, this might sound a little technical, but bear with me.
Okay, I'm all ears. Break it down for me.
Imagine you're looking to buy a house. You wouldn't just look at the asking price, right? You'd consider the location, the size, the condition, the potential for appreciation. You'd try to figure out what it's truly worth.
Yeah. You'd want to make sure you're not overpaying.
Exactly. Intrinsic value is about doing the same thing with companies. It's about looking beyond the current stock price and estimating what the company is truly worth based on its future earning potential.
It's like peering into a crystal ball and trying to predict the future of a company.
In a way, yes. And Buffett's really good at it. He's got this incredible ability to analyze a company's fundamentals, look at its management team, assess its competitive landscape, and make a pretty accurate prediction of its future earnings. But here's the key. He doesn't just buy at the intrinsic value. He looks for what he calls a margin of safety.
Ooh, a safety net. Tell me more.
It's like adding an extra layer of protection. He only buys when the stock price is significantly lower than his estimated intrinsic value. This gives him a cushion, room for error.
That's actually brilliant. So even if his estimations are slightly off, he's still likely to come out on top.
Exactly. It's all about managing risk and protecting your downside.
It makes sense. This is all fascinating, but it makes me wonder, can anyone learn to do this? Or is Buffett just one of those rare geniuses?
Well, Buffett certainly has a unique talent. His principles are something anyone can learn and apply. And that brings us to one of his most famous pieces of advice. Invest in what you understand.
So, we're not all expected to become experts in every industry.
Definitely not.
Right.
Buffett himself famously steered clear of tech companies during the dot-com boom. He admitted he didn't fully grasp their business models, so he stayed away. And guess what? That saved him from a lot of potential losses.
He stuck to his lane and came out on top. That's a pretty powerful lesson.
It is. It's about knowing your strengths, your areas of expertise, and sticking to those. It's about resisting the temptation to jump on every bandwagon.
It's about being self-aware and playing to your strengths. I like that. But this all requires so much patience. I'm definitely more of an instant gratification kind of person.
I hear you. But remember, Buffett's a marathon runner, not a sprinter, and building wealth takes time and discipline. Speaking of discipline, let's talk about how Buffett views debt.
Debt? That doesn't sound very exciting.
Maybe not, but it's crucial. Buffett sees excessive debt as a huge red flag. He prefers companies that fund their growth through earnings, not borrowed money. Think of it like building a house on a solid foundation versus building it on stilts.
Okay, I see where he's coming from. A strong foundation is essential. But why is he so against debt? Don't most companies use it to grow?
They do, but excessive debt makes a company vulnerable. What happens if the economy takes a downturn or interest rates spike? Suddenly, that debt becomes a massive burden.
It's like having a heavyweight dragging them down.
Exactly. Buffett's own company, Berkshire Hathaway, is known for its conservative approach to debt. They're a fortress built on solid ground.
So, slow and steady wins the race, just
Yep.
like the tortoise and the hare. But let's be honest, even Buffett must have made some mistakes along the way, right? Nobody's perfect.
You're absolutely right. Even the greatest investors make mistakes. The important thing is to learn from them.
Do you have an example of a time when Buffett stumbled?
Well, one of his early investments was in Berkshire Hathaway's own textile business.
Wait, wasn't that his company?
It was. But the textile industry was on the decline, and even Buffett couldn't turn the tide. He later admitted it was a mistake to hang on to that business for as long as he did.
So even he can misjudge an industry or a company's prospect.
It happens. But the key takeaway is that he learned from that experience. He realized that sometimes you have to cut your losses and move on.
So even the oracle isn't infallible. That's actually kind of reassuring. It makes him seem more human.
He is human after all, and that's a valuable reminder for all of us. We're all going to make mistakes. But it's how we handle them that defines us.
Absolutely. Okay, let's shift gears a bit. What about diversification? Isn't that supposed to be the golden rule of investing?
It's certainly a popular concept. The idea is to spread your investments across different assets to reduce risk.
Don't put all your eggs in one basket, right?
Exactly. But Buffett's approach to diversification is a bit unconventional. He's more of a concentrated investor. He prefers to focus on a few truly outstanding companies.
Really? So he goes against the conventional wisdom. That's bold.
He does. His philosophy is that if you've done your research and found exceptional companies with strong moats and great management, it's better to invest heavily in those than to spread your money thin across dozens of mediocre companies.
So it's like saying, if you find a winning horse, bet big on it.
That's a great way to put it. Look at his portfolio. It's heavily weighted towards companies like Apple, Coca-Cola, and Bank of America. He puts his money where his mouth is.
That takes a lot of conviction. But I guess that's what sets him apart. He's not afraid to go against the grain and trust his own judgment.
He does. It's pretty remarkable.
It really is. So, Looking back, everything we've learned today, is there a common thread that runs through all of Buffett's principles?
Absolutely. It's all about simplicity, discipline, and a long-term perspective. Buffett doesn't get caught up in the hype or the noise of the market. He focuses on the fundamentals. Understanding businesses, finding value, being patient, and staying the course.
It's like he's found this Zen-like approach to investing,
Yeah.
right? Just staying calm amidst the chaos.
Exactly. He's not trying to time the market or make a quick buck. He's in it for the long game, building wealth slowly and steadily.
That makes sense. But honestly, it sounds easier said than done. It takes a lot of discipline to resist the urge to jump on the latest trends or sell when things get a little shaky.
It does. But remember, even Buffett had to cultivate that discipline over time. Nobody's born with it. It's about developing good habits, learning to control your emotions, and sticking to your plan.
So it's like training for a marathon.
Yeah,
You can't just show up and expect to run 26 miles without putting in the work.
that's a great analogy. Investing is a journey, not a sprint. It takes time, effort, and dedication to achieve your goals.
Okay, that's inspiring. So for our listeners who are just starting out on their investment journey, what's the one piece of advice from Warren Buffett that they should take to heart?
If I had to pick just one, it would be to invest in what you understand. It's so simple, yet so powerful.
I agree. It's about staying within your circle of competence, right? Not trying to be an expert on everything.
Exactly. Focus on industries and businesses you know well. Do your research. Read the reports. Understand the fundamentals. Don't be afraid to ask questions and seek out advice from trusted sources.
And remember, it's okay to start small. You don't need millions of dollars to start investing.
That's true. The key is to start somewhere. Develop good habits and learn as you go.
This has been an incredibly insightful deep dive into Warren Buffett's world. I feel like I've not only gained a better understanding of his investment strategies, but also a glimpse into his mindset and philosophy.
I'm glad to hear that. And remember, even though we can't all be Warren Buffett, we can all learn from his wisdom and apply his principles to our own lives.
Absolutely. So to all our listeners out there, remember that successful investing is a journey. Start today, stay disciplined, be patient, and never stop learning.
And most importantly, enjoy the ride.
That's the perfect note to end on. Thanks for joining us on this deep dive into the brilliant mind of Warren Buffett. We'll see you next time for another fascinating exploration of knowledge and ideas.